Okay, this is Jim and Jeff again for the Monopoly Project and the Monopoly Project 2. We're here to talk about the house we just bought, and we're getting it ready to rent. We've explained that in a previous video, but now we're going to talk about the capital contributions and how we made a mistake and how we're going to resolve it. And so to try and explain this, Jeff, I was going to start at the beginning with theory, and I'm going to use round numbers so we don't get lost in all the little numbers and everything.
Got it.
And so
that's good.
I think the first point I wanted to make is there are cash and non-cash contributions to the partnership, and you've talked a lot about this, strengths that you bring, strengths that I bring, and so that's going to be key to understanding how this money flows. The first thing is that Jeff and I went into this and are still in this as dollar for dollar partners. We're 50-50, and so if I put $1 in, Jeff puts $1 in. So we had calculated it was $60,000 to close. It was actually a little, different, but like I said, I'm going to use round numbers. And so there's two partners in here. Let's call them Jeff and Jim, right? And so what we should have done is we calculated that we needed $60,000 to close. So Jim puts in 30, Jeff puts in 30. When we got to the end, we were $5,000 short for a reason we'll explain later. And so had we done the dollar for dollar, I would have put another $2,500 in, you would have put another $2,500 in. So that would have been $32,500 for me, $32,500 for you. Plus we funded the LLC with $3,000 each. So we would have put $35,500 in.
Okay.
That's if everything was clean. The complicating issue was that Jeff is the agent for the buyer on this deal. And so therefore he gets a commission, and Jeff wants to contribute that commission to the partnership. And so we have to figure out how to include that. And what we did previously is we did that in the middle, on a spreadsheet, and I did it wrong. So
it's probably better what I would have done, Jim.
Simply put, I did it wrong. And I thought about it. But anyway, I'm going to explain why. So Jeff's the buyer's agent. He earns a commission on the sale, typically, half of the 6% traditional. But for this argument, let's say it's just $6,000. And that's pretty close to the real number.
Right. And for this transaction, it was 2.5%.
It was a 2.5% deal. But regardless of that, let's say it's the $60,000 to close. With the mistake we made, another $5,000, and now Jeff's going to contribute his $6,000. But Jeff has to subtract his expenses. Right? And so you bought coffee for the client, you bought gas. Those are all pretty de minimis, right? They're zero, right? But there is a big expense that Jeff has, and that is the government. The government considers this income, and Uncle Sam and Cousin Doug Ducey's our governor here in Arizona, they're going to want their cut, right?
That's right.
They're going to want their cut. So that's a real expense. You don't get $6,000 in your pocket. So let's see what you do get.
This is great.
Jeff is in the marginal 33% rate. That's federal plus state. If you make money up to a certain amount, you don't pay any taxes. The next chunk of money, you pay 10%, then you pay 15%, and then you pay. And eventually, it used to go up to 39% was the top marginal rate, federal only. Then you have to add the state. I think in the tax cut early on in the Trump administration, it went down to 35%. But I'm going to assume a 33% tax rate, federal plus state for Jeff. So his $6,000 is really $4,000 in his pocket, right? And so he applies the entire $4,000 to TMP2. And the question is why, right? Why not he just says, well, this is my money, I earned it, I'm keeping it, right?
Right.
But he wouldn't have earned this absent the partnership. This deal wouldn't have happened. And here's where it comes into the question of partnerships and bringing diverse skills. Each partner brings diverse skills and attributes to the partnership. In this case, Jeff earns an actual cash commission on a deal. Typically that doesn't happen. Now, for example, if I was a loan broker and I provided the loan, I would get a 0.5% fee, right? Or if I owned a title company, and I would get a fee. But in this case, you're getting cash compensation. But as an example too, Jim does illegal financial accounting, but he
Yeah.
doesn't earn any dollars off that,
That's
just
true.
like Jeff does.
Yeah.
Jim provides liquidity, which is
Yeah.
risk reduction, and that's where the $5,000 I talked about is going
Right.
to come up later. So the rationale for applying the entire contribution in your pocket is those two things.
That's good.
Yeah.
That
So
makes a lot of sense.
so Jeff applies the entire $4,000 to TMP2. So is he losing $4,000? No, because as a partner, he owns half of 2,000. So 2,000 of that 4,000 is still yours. In fact, the other 2,000 is in the partnership.
I see.
So
Yeah.
Okay.
Okay.
so why absent the partnership he wouldn't have had the 4,000 in his pocket? It represents an activity that provided direct compensation, cash compensation to the partnership. The other activities, the day labor at the property and all that,
Yeah.
we could have quantified those in cash and say, that's your contribution. But
Yeah.
for a partnership at this level, that's way too complicated. I mean, some of the
Yeah.
really big, super big, syndicated real estate
Yeah.
deals, they do those kind of things. The partners charge
Yeah.
money for their expertise.
And it's really good we're going through this now because this can be our model
Right.
moving forward. And I know the banking's a lot more fluid now and systematic, so
Yeah.
this will be nice to get it down.
Yeah. So applying the entire after-tax cash acknowledges that most of the activities do not provide a cash income, but a few do. This is one example. So I use the round numbers there because it's a lot easier to talk about. But next we're gonna redo the numbers using the actual numbers from the bank statement, the bank statements and the closing statement I just showed you previously. And one of the things I wanted to talk about later is whether it's a good idea for you doing a monopoly project of your own to get a real estate agent license to capture 3% of the transaction, 3% before taxes.
Right. Right.
And I can argue yes and no, and I'd like to hear your opinion later when we have a chance to think about it and talk about it.
Okay.
Because we're buying, because of Jeff's status as an agent and him getting, effectively 2% back because the government taking the 1%, we're buying property 98 cents on the dollar, which is a good deal, right?
Yeah.
I mean, it's not
Right.
going to make the deal better or worse, but it's nice to have a 2% discount.
Right. Absolutely.
It's like
Absolutely.
we have one of those credit cards that gets 2% back because of Jeff.
Yeah, that's right.
Thank you, Jeff.
You're welcome.
So, anyway, that's the theory. Now let's look at the actual numbers.
All right.
Okay, it's Jim and Jeff back again for the Monopoly Project. We're talking about the house we bought, and it's closed. We did the repairs. Sherman's just about to rent it, and so we're here to talk about the accounting and how we settle up the accounts. In the previous video, we showed you the theory of how partners contribute money and how you take into account cash versus non-cash contributions to the partnership.
Right.
And we use round numbers then because it's a lot easier. Now we're going to do the actual numbers, and this is your copy, and so I'll just leave that there for now.
Oh, okay.
But we can just go through this one. This first sheet here, and I can show it on the blog later. This first sheet is a time history of the money we put in.
Good.
And it's sort of, that's where the confusion comes in because the time history mixes up the cash versus non-cash contributions.
Right, right.
And so I just wanted to do that. The next page I'm going to show takes it out of the time contribution and puts it into the cash versus non-cash. And obviously the numbers end up the same.
I see.
But what we did is on the 22nd of January, we each contributed $3,000 as capital funding of the LLC, which is a legal requirement, right?
Right, right.
On the 11th of February, we got the draft closing statement that said we needed rough $60,000 to close. So Jim put in $30,000, Jeff put in $25,695 because we had subtracted out incorrectly the expected cash contribution from Jeff's commission, and I did that wrong. So for that reason, And all for that reason, we were short of money when the closing statement came in. And there was another reason, that because Brian, our loan officer, said that contributions to the buyer side are capped at 2%.
Yes.
And so we were 5,000 short. So Jim put in $5,000 from TMP, the TMP Monopoly Project account,
Yeah.
to cover that. And this is an example of
Right.
where one of the partners brings something to the table the other doesn't,
Right.
and isn't necessarily compensated for it in
Right.
cash.
Yeah.
Had we not had that liquidity that, the bank
Right.
of Jim and Michelle, we had a big problem. Right? It's closing
Right.
tomorrow and we're $5,000 short. What do we do?
Right. Absolutely.
So, but we could easily put that money up, and I trust Jeff, and I know we're going to settle it up. And we could have wrote a legal agreement. We could have did all this and that, and we didn't need to do that. We got a
Right.
handshake, right?
We do.
Yeah. And
Indeed.
so we're settling up now.
Yes, sir.
And so again, and then on the 16th, I transferred $5,000, and on the 16th, Jeff could only apply $2,170 of his commission because of that 2% limitation, and because we were really good negotiators, and we got the seller to give us a $2,750 credit.
Yeah.
And so
That's right.
So that's
right.
good.
It's really good.
So as of the 16th, which was closing day, Jim had contributed $38,000. Jeff had contributed $30,865.
That's good. That's a very good accounting.
Right.
Yeah.
Okay. And this is where it gets complicated in the non-time frame.
Yeah.
To make everybody whole again, this number has to be 30,000, right? And I'm pointing to the 30,000 that we calculated on closing.
Right.
So Jeff needs the 4305 to make this 30. Jeff needs to add another 5,000 to match this, to match the 5,000 loan, or we could give the 5,000 back to TMP, but the problem is then we don't have enough money to pay all our bills, as you'll see on the next page.
Got it.
Yeah.
Got it. Okay.
So, and then finally, you put in 2170 of the commission. The commission was actually 6150.
Right.
And I got to check that number because I couldn't find it on any of the closing statements.
Really?
But that's what I remember. And
Yeah, it was 6150.
Yeah. But again, so if it was 6150, and now I'm gonna calculate Jeff's in the 33% tax. Previously we used 30, but I think 33 is better. So taking out the 33%, then that leaves 4,100. One third, 2/3 of 61. So you already contributed 2,170, so you need another 1,930 to make it. And so the total Jeff contribution needed is 11,235.
Okay.
And the reason why I say we can't give that loan back is because we don't have enough money. And here's the balance. The current balance in the account is $1,620, right? The accounts payable, we have some accounts payable, which is a lot of it is to us. To us as individuals. You can see there's $1,369 in accounts payable.
Right. Okay.
But the big one, of course, is Bill with Southwest Home Tenders. He's done. He should be done with his work. He sent us an invoice for like $3,350. Two invoices, one for the inside work, one for the outside work. And so there's $4,800 in invoices, in outstanding APs that we need to pay. And so if you take the 1620 that's in the account, take off the 488, if you put in the 11, then we'll end up with 8,000 in the bank account.
Okay.
And that's what I'm saying is we can't give the 5 back because then we would be.
And that will be at the end of the account, so we're actually sitting okay for our next investment.
Exactly.
Is that the idea?
Exactly.
Okay.
Yeah. When we go to the next investment,
good.
especially if it's just an earnest money, there'll be enough money easily to do that.
Okay.
So.
Okay. Good. That's
So-
good. I like that.
Yeah. So that what I want to do is I wanted to go back and to me I get lost in these and I get confused, and for my own sanity, what I did is I went back with an alternate view.
Yes.
Yeah, I'm letting Jeff take his notes because
Okay,
I know it's
yeah.
important to take notes.
Yeah.
This is an alternate view. It's not in a time sequence. It's cash at the top and one for one cash at the top,
Right.
and then your contribution of your commission.
Right. Right.
So again, we start we start exactly as we did before. On the 22nd, we each put 3,000 in, right? On the 11th of February, Jim put in 30, Jeff put in the 25,695 because of our mistake.
Right.
So to make that whole, on the 25th, you know, and I just use this tomorrow,
Yeah.
you put in the 4305, so that makes that whole.
Yes, sir.
You put in the 5,000, so that makes that whole. And now both sides have put in 38,000. 38, yeah, 38
Yeah.
even.
I actually prefer this model.
Yeah, it's a lot simpler. And then we come below the line.
Below the line.
Yeah, and Jeff contribution to the close of escrow. You've already done the 2170. That's buried in the closing statement.
Yeah.
But you need to add the 1930 to make it the 4100.
Okay.
So
in that scenario, what would be the dollar amount that I would write? The same dollar amount?
it's the
or
same. Yeah,
It's the same.
yeah,
Okay.
yeah.
You're just coming to it from a
You're
different
adding
way.
this, and this.
Okay,
Whereas
good,
here
good.
I added them here, and here.
Got it.
Right.
Okay. Cool.
And this last page is the accounts payable.
Right.
There's
okay.
$1,620 in the bank.
Okay.
We owe Jim the TMP2 partnership owes Jim
Yeah.
$1326 for the refrigerator
Yeah.
and various invoices that Home Depot. $56.00 to Jeff for keys and fasteners.
Yeah.
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 And I got a copy of that.
Okay. Good.
And then, like I said, for the exterior painting, we owe $22.75
Okay.
to Southwest Home Tenders. The interior work, we owe them $11.50. And so that's the sum of the accounts payable, 48, and that's the shortage.
Okay. So that 1620 that's sitting in there right now, that's excluding the 8,000 backed on that we have, this one right here, balance. The 8,048, is that prior? Well, that's what we're going to have before we're paying expenses.
No, that will pay the expenses also.
Oh, wow. So we will be sitting there with
Yeah.
8K after all expenses are paid.
Yeah.
Okay,
So
gotcha.
basically the account is 1,600 now. You add 11.
Yeah.
So that's 12. There's 4
That's smart.
expenses.
Paying forward a little bit.
Yeah, and then
Yeah.
you don't have to go make cash contribution calls and such.
Okay, I like
So-
it. Well, I'm just asking so I can explain that to my wife.
Well, yeah, no, I understand. And so, yeah, if you need, if you need any.
In fact, this is a good lesson because next time I'll bring Alex because she's going to ask me questions and I'm going to have to explain this and I won't do nearly as good a job as Jim has done here.
And so anyway, so
Okay.
that's our accounting, and like I said, you can see the numbers on our
Okay, good.
on our spreadsheet.
So what I'll probably do is go get a cashier's check today. I won't do a wire because we don't have immediate need for the money, right? I mean, I can just do a cashier's check.
Well,
Or you think I should do a wire?
I guess I think a wire is fine.
Okay.
I mean, a cashier's check is fine because we don't have to pay bill, Southwest Home Tenders. I mean, typically, commercial accounts are net 30 days, and I don't have any problem with paying bill
Right.
right away if we had it, but I
Yeah.
don't want to.
And the last time we did this, it took, what, 2 business days to clear?
Yeah.
Okay.
Yeah. And I think the actual rules in the bank is the first 5,000 is immediate.
Okay.
And the problem is the balance. So,
Okay.
let's check on that.
Yeah, I will. Okay. Awesome.
Okay.
Okay, that sounds awesome. And I feel good because it's going to be square and now we can move into our next investment and we've got a little bit of seed money. So this is good.
Okay.
Yeah. Yeah.
Okay.